Dennis Foster has another of our econ faculty. He hasn't been here very long. He got here in 1990. He's only been here a short time. He has a BA from Drake University and an MA and a PhD from the University of Hawaii. He's going to talk about interest rates and inflation, which should be really interesting because there aren't any. Yeah, so it'll be interesting to hear his remarks.
Well, thank you very much. It's a pleasure to be here and to speak to you about the issues involving the economy, although I get the sense that Ron is agitating to be the next Fed chairman with some of his comments there. I wouldn't be surprised if that actually happens. Now, it turns out, Elliot and Ron and I have actually been doing this a long, long time, and you may not know this, but I went through and I found some of my old PowerPoint slides that showed one of the earlier presentations that we gave. That's right, we did speak at the 10,000 BC Economic Outlook Conference, although I must admit there weren't really dinosaurs around during that time, but they looked really cool on the brochures. And we pretty much told the same kind of stories that we tell today. Elliot, for example, would talk about housing and how there weren't enough caves around and how some caves were empty and we needed to try to find ways to sell more. And he would bring really cool pictures to show people and to entertain them along the way. Ron, of course, always very cheerful while he told us tales of doom and gloom and how we were going to die from exploding volcanoes and meteorites falling out of the sky. I would bring a lot of my charts and my data, talk about the economy, and then rail against wasteful government spending and encourage more market activity. So the kinds of stories that we tell today is still the same kind of stories that we've been telling for really quite some time. Well, today I'm going to touch briefly on some of the macroeconomic conditions, look at the meaning of money, talk about Fed policy and effects, and then give you my particular views on the economic outlook here. This chart shows that Ron was totally wrong about everything he said. And that is the aggregate growth in real GDP since the bottom of the recession. You can see that our current recovery, we're 25 quarters into this recovery, we're up 14%. Much lower than the last three business cycles before that. Under President Bush, we were up 18% at this stage. Under President Clinton, up 24%. Under President Reagan, up 33%. This chart also shows how long those recoveries lasted. And you can see that our current recovery has lasted just as long as the last one did before we went into a recession. And the other two recoveries lasted 2 to 3 years longer, which means we're starting into areas where, at least based on the evidence of history, we should be expecting another recession. This chart shows the federal funds rate of interest, which is the primary rate of interest that the Fed uses to manipulate the economy. The shaded areas show the recessions over the last 15 years, so in 2001 and 2008. And you can see that what they do when we have a recession is they push that rate down to try to stimulate spending, try to stimulate production, try to stimulate economic growth. During the recession of 2001, they pushed that rate down to 1%. And during the last recession, 2008, they pushed that rate down to essentially zero. Now, the Fed then waits for the economy to recover, waits for the economy to perform pretty well. Then they start raising that rate. And of course, as you can see, they haven't raised that rate yet. We've 6 years now of this interest rate at zero. And I'm afraid we're going to hit another recession before they ever get around to actually doing anything about that. Here's a couple of other interest rates to paint a little broader picture. The rate on U.S. Treasuries, the 10-year U.S. Treasuries, and the 30-year mortgage interest rate. This chart shows the consumer price index over the last 15 years. We've had maybe 1 to 2% inflation on average per year since the recession. And in fact, and sometimes it's been negative. But even so, going back 15 years, you can see that general price level has risen nearly 40%. Now, the Federal Reserve's mandate is primarily to maintain stable prices. And I wouldn't say that 40% inflation over 15 years really meets the condition of having met that mandate. But that's the way the Federal Reserve tends to act, and we'll look at some more of that here in a moment. So I want to consider briefly what is interest and what is inflation, and then take a little deeper look at this. Interest, as you know, is a payment that's made to savers to compensate them for giving up current consumption and deferring that into the future. The way some people put it is that interest is the time value of money. $1 today is not worth what $1 is a year from now or 5 years from now or 10 years from now. And that relationship is embedded in that phrase there, the time value of money. Inflation is a rise in the general level of prices, or conversely, a decline in the value of money. One of the quotes that I often bring with me to this presentation from Milton Friedman, that I'll bring once again, is inflation is always and everywhere a monetary phenomenon. Now the key point here is that interest rates and inflation are tied up with the value of money. And who controls money? That's not a rhetorical question. It's the Federal Reserve, all right? It's the Federal Reserve controls money. They're charged with controlling and maintaining money and controlling and maintaining the value of money, all right? So the problems that we have with interest rates and with inflation can be laid directly at the policies of the Federal Reserve. So let's take a look at money just a little bit more closely so that everybody understands what we're talking about here. Money is a medium of exchange, what we call a medium of exchange. That means if I'm a baker, I bake bread, and I want chickens, I got to find somebody that has chickens, wants to sell bread. And let's say that I can't find anybody, but I can find someone that raises chickens and wants to sell it for corn. So I go out and I try to find somebody that sells corn or wants to trade corn for bread. I find them, I make the trade, I take the corn, I trade for the chickens, everybody gets what they want, and in this little exercise, corn serves as a medium of exchange, meaning that I didn't want the corn. I wasn't interested in consuming it. I didn't really want to acquire it. I only used it for the purposes of trading for what I actually wanted. Now, that doesn't make corn actually money. Money is a medium of exchange, but not everything that's a medium of exchange would be counted as money. To be counted as money, it has to be widely accepted. I suppose there might be some societies in the past where corn might meet that particular definition, but as a general rule, to become money, a commodity has to meet these particular criteria. It should be durable, it should be portable, should be divisible, should be recognizable, convenient to use, and relatively scarce. Now, over time, that tends to be precious metals in general, and gold in particular. In the US, our money was defined in terms of gold for more than 100 years, and that was true of currencies all around the world. That's what we call the gold standard. The idea about the gold standard, a couple things to note. First of all, you can't inflate the money supply when you use a commodity like gold as your money. You can't just create gold. Even though we'll oftentimes use pieces of paper to exchange for gold, you can't just print up as many pieces of paper as you'd like. A second point to note about the gold standard is that people can save for the future without participating in financial markets. When we think about savings today, we think about, well, you have to buy stocks, you have to buy bonds, you have to buy mutual funds. Well, in the days of the gold standard, you could save in terms of money. You could just save money. Gold's going to hold its value over time. Now, that's especially important for people at the lower end of the income scale that are not likely to participate in financial markets. Well, of course, we don't have a gold standard anymore. Gold standard was eliminated in 1933 under an executive order by the president, and then validated by congressional acts that followed that, where we were required to give up our gold coins and gold certificates and bullion under a very serious threat. The penalty for not complying was $10,000 fine or 10 years in prison or both, which, this is 1933, a $10,000 fine is pretty stiff. Now, John Maynard Keynes is sort of famous for having said that the gold standard was a barbarous relic. He didn't think very much of it and was okay with the fact that we had pretty much moved away from it. But I'd have to ask, well, if it's really a barbarous relic, if it's really obsolete, why were the penalties so high to keep people from actually using gold and actually holding on to it? Well, the reason, of course, is because Keynes was wrong about that and pretty much everything else. But we'll talk about that during the panel discussion. So what has the Fed done to our money? Well, the Fed's been around since 1913. As Ron mentioned, that was also the year that the amendment was passed that added the income tax to our lives, so it was a pretty bad year in all ways. Since then, the value of the dollar has fallen about 96% over the first 100 years of the Fed's life, so until 1913. Now you can see on the chart that the purchasing power of a dollar bounced around a little bit, but once we had the end of the gold standard in 1933, pretty much the value fell continuously since then. So that means a dollar in 2013, a dollar sort of today, buys 4 cents what a dollar would have purchased in 1913. And that also means that you would be a fool to save in the form of money. I mean, that would be the worst thing you could do. So the only way you can save for the future now is to participate in financial markets. And what's the Fed going to do in the future? Well, their stated goal is to try to have 2% inflation. If you read the FOMC minutes or their press release, they were constantly going through this, into this issue of saying, well, we think 2% inflation is what we should have in our economy. Now, the Federal Reserve Act sets out that the mandate of the Fed is to achieve stable prices. And somehow they have managed to redefine stable prices into 2% inflation. I don't remember seeing any debates about that. It didn't come up the other night in the presidential debate, yet it seems to be kind of a big deal. If the Fed lasts another 100 years, and we can hope it doesn't, the dollar will continue to deteriorate in value so that it falls by almost a comparable amount. Well, before there was the gold standard, the Fed couldn't just print up as much money as they want. Since then, of course, they can do whatever they want in terms of increasing the money supply. I have here a chart that shows bank excess reserves from 1985 to 2008, and those are measured in millions of dollars, so that what you see there is that for about 20 years, banks held about $1 to $2 billion in excess reserves. Now, banks don't typically want to hold excess reserves because they don't earn income off of it. They'd rather have those assets into loans that are going to earn them something. You can see there's one exception there following the attack of 9/11 where that jumped up to $18 billion. Well, things since the recession, of course, changed dramatically. This chart shows what's happened to those excess reserves up till 2015. Through a series of programs called quantitative easing, which people refer to as QE1, QE2, and QE3, excess reserves in the banking system are now at $2.5 trillion. That's a big increase from just $1 or $2 billion. And what the Fed has done here is they have created a landscape that is ripe for massive inflation. Now, we don't see massive inflation. We haven't seen it yet. But if the banking system decides that it's time to lend out some fraction of this $2.5 trillion that they're holding as excess reserves, I think what we'll see is an inflationary spiral that's going to take off and make any of our previous experiences with inflation look rather tame by comparison. So what's my outlook? Well, you know it's pretty pessimistic in the long run, but in the short run, it's not. I don't think anything's going to happen to interest rates. I think they're going to stay low for the foreseeable future. The Fed may raise them a quarter of a point, a half a point. It's not going to be meaningful in my mind. Economic performance is still pretty slow, so I don't think they're going to feel compelled to do anything about that. I think that inflation is still the looming danger, even though many others disagree. And one of my concerns is once inflation starts, we're going to embed that in all our decisions, and I don't think the Fed's going to be able to undo any of that rather easily or in a way that's going to be less painful than what we're likely to have. Paradoxically, I guess you might say, I think the worst case scenario is that the economy surges, banks increase their lending, and then that starts us down this road of dramatic inflation. And the best case scenario is really exactly what we have. A sluggish economy, one that just barely limps along. Banks are content to hold these massive excess reserves. They aren't too encouraged to try to lend that out. And the big question here is, how long can that last? I didn't think it was going to last 6 years, but it has. Maybe it'll last another year, maybe it'll last another couple of years, but that's probably it. Well, I like to be as positive as I can at these presentations, so I do want to close with my top 10 list. This is the top 10 actions by President Trump that no one saw coming. Number 10, he'll convince the Chinese to change the name of their country to losers. Number 9, he'll also build a wall between the U.S. and Canada and get Mexico to pay for that one as well. Number 8, he'll have sing-alongs on Make America Great nights, previously known as Tuesdays. He'll get Iran to give up their nuclear weapons program by getting Kim Kardashian to move to Tehran. Number 6, he'll sign an executive order making low energy a misdemeanor except in states where marijuana is legal. Number 5, he'll sign legislation that will add his hair to the loser presidents on Mount Rushmore. Number 4, he will successfully fire Vice President Carson. Number 3, he will gold plate Air Force One, although I must admit everybody saw that one coming. Number 2, he'll declare 1750 as the year of the woman. And the number 1 action by President Trump that no one saw coming, he'll keep Obamacare, but he'll change the name to Trump Care. Thank you very much.